Hello and welcome to Bitlemmas episode 16. I'm Watson. I'm here with B Sovereign, and today is a book review of A Monetary History of the United States by Milton Friedman and Anna Schwartz. The point is not to memorize monetarist slogans. The point is to understand their system model. Money is institutional plumbing. And when the plumbing fails, the real economy fails. The old story says money is mostly a veil. It changes prices, not production. It changes labels, not real economic life. Friedman and Schwartz make the story much harder to believe. Bank deposits are part of the money stock, and when banking panic destroys deposits, money disappears. When money disappears, spending, income, prices, and output can collapse. We'll be reviewing four counterintuitive truths. Money is not a veil. Banking panics are monetary shocks. The Great Contraction was preventable. Centralization is not competence. So, what is this book about? It's a long empirical history of US money, banks, panics, and policy. What's the core question of the book? It's how does the money stock move the real economy? We're going to talk about what money stock means. The central case that he's getting at, Milton Friedman and Schwartz, is the Great Depression as the Great Contraction. We'll talk about what that means. And the method that he uses is he traces institutions, data, and policy actions over time. So within that, there are many monetary crises that he looks at even before the Great Depression. And so he's using that and the money stock within each one of those crises, and so that he can find patterns instead of treating crisis as an isolated event. So what's the standard story that Milton Friedman has a problem with? He's saying that classical economics and even neoclassical economics, within that framework, money is a veil. What does that mean? We'll talk about it, but it's that real production is what matters and not actually money or monetary policy. And so within the classical economics, who's he talking about? We reviewed some of these people before. So we have John Say, who says that supply creates the demand. You also have John Stuart Mill, and you also have some like more political scientists slash classical philosophers like David Hume and some others, where they say that money is really accidental to the economy. And then we're going to dig into why Milton Friedman says no, it's actually a very important part uh, of the economy, to the point to where you can crash the economy if you don't pay attention. Panics are just confidence problems or Wall Street drama. That's what some of these economists slash philosophers, political scientists were saying. Central banks exist, so monetary collapse should be impossible. Again, this is the standard story. The Depression was market failure, not a policy slash institution failure. So this one is controversial. Most people do believe that the Depression was some type of failure of markets or greed or something like that. It required regulation, but it wasn't the Fed that failed. And so we're going to dig into why he believes that it was the Fed. Now, what's the thesis of the book? Again, money is not a veil. It's part of the operating system. We're going to talk about what this operating system. is banks create and destroy money through deposits. We've reviewed some things that are saying this before, but he has a way of describing it that we're going to get into. Panics can turn bank failures into money stock collapse. And then policy can stabilize the system or amplify the shock. Now, two major premises of the book. Money stock equals currency plus bank deposits. What does that mean? Currency in this framework, he's talking about physical cash. And then as separate from bank deposits, so you take your physical cash and deposit it into the bank, then it's a bank deposit. Now he has a concept of high-powered money. High-powered money and bank ratios. What's a bank ratio? That's going to be how much they have in reserve versus how much they've lent out. They jointly shape the total. The total what? The total money stock. What's high-powered money? One way to think about high-powered money, it's money that has the potential to be multiplied. So we'll talk about this some more. Gold, treasury actions, and Fed actions all alter the base. The base what? The base money. Authority is divided, and divided authority can fail in crisis. What is he meaning there? So this is part of the paradox of Milton Friedman. Because in this book and other places, he says clearly that government should be involved in setting monetary policy in some way. But it needs to be very, very strict. And he lays the blame of what he calls the Great Contraction, so the Great Depression, he lays the blame at the feet of the Fed. And why? He says that they were a bureaucracy. There's two reasons why there was a failure. And he's saying that the Great Depression could be prevented. We're going to talk about it. But he's saying that they were incompetent. They misdiagnosed. And even if they did diagnose correctly, they were a bureaucracy. And so they had they devolved into different leaders, different, people on the board or what have you. And they weren't able to make fast decisions. And you need to have fast decision-making power. You need to have, counterintuitively from Milton Friedman's framework and what he's known for being an absolute enemy of central authority, if you're going to handle crises, you do need, and you're going to do it with an institution, you need a central authority, not a divided bureaucracy. So that was his critique of the Fed. Now, 4 counterintuitive truths. Money's not a veil. We're going to dig into that, but it's basically the classic economics view of money is incorrect from his point of view. Truth number 2, banking panics are monetary shocks. Okay, we'll dig into that. The Great Contraction was preventable. That's controversial for most people. And then truth number 4, centralization is not competence. So for this community, definitely not that controversial there. Okay, truth number 1, money is not a veil. The stock of money changes spending capacity. What does that mean? Spending capacity in the stock of money. So velocity, so there's 2 concepts within velocity. There's money income, and then there's the money stock. So what is money income? Money income, if you were to take the total amount of transactions for the whole country for the year, let's say, if you added them all up, that would be money income. So and then you can call that velocity. When the velocity is increasing, money income is more than money stock. Why? For or it's argument for why money matters. I mean, we'll talk about it on the next, a bit on the next slide. But the confidence matter. So lots of people agree that velocity matters. You want people having economic activity. People kind of think about that. That's what he's calling velocity sometimes. Confidence. So you've heard the phrase of, consumer confidence or what have you. That matters, but the money is still causal. So money stock. Falling prices do not prove policy was easy. What does that mean? So within the Great Depression, so we're talking 1929 to 1933, not many people don't know is there was deflation. Prices were falling. So people's paychecks were falling. We know that, but prices were falling too. And the Fed, we'll get into this, but the Fed was saying, well, we reduced the interest rate. All good. What can we do? This is what we do. And what Milton Friedman is saying is that you all misdiagnosed. You did not look at the money stock. You didn't look at the deposits were being destroyed because people were pulling their money out. So you said, oh, prices are falling. Well, that's all we can do. And it took too long. This is part of why he was saying his critique of the Fed. So a stable looking boom can hide deflationary. So when prices fall, it means your purchasing power increases with the amount of purchasing power you have, increases. That's deflation. So I had deflation.
Mm-hmm. Mm-hmm. And I mean, to add on here, a bank run is not, it's not just a confidence crisis. We're looking at it from the terms of monetary contraction in real time. When depositors are getting scared, we talked about this in the last book. They withdraw cash. Banks sell assets to meet withdrawals, reserves deplete, and the deposit currency ratio also falls. The money multiplier falls, and 1/3 of the money stock had disappeared between 1929 and 1933, just stepping through what had happened at the beginning of the Great Depression. So the key insight here is that the money stock is a measurable quantity. When banks fail and deposits disappear, the money disappears. The real economy doesn't notice a confidence problem. It notices that the money to buy goods, pay wages, and settle contracts no longer exist. So Friedman and Schwartz contribution is to make this legible, and they traced the data, they showed the mechanism, and they named the contraction, which is the Great Contraction.
All right. So now here is a way to reason about money or the money stock chain. You have high powered money. What's high powered money? It is money that can be multiplied, has the potential to be multiplied. So that's the very top layer here. Then you have bank ratios. What's a bank ratio? That's the reserve. So you can have, the easy to reason about is you can say the bank reserve is gold. You also can have cash. There's also behind the scenes something called FedWire. It's what they have that is not multiplied. It's the base that's not multiplied. And then the ratio is how much they have multiplied. So, and then there's the currency demand. It's how much people want to have the cash. So currency demand is one of the things with currency demand is when people say, I want to withdraw my physical cash from bank on a bank run, that would be demand. Now, then you have deposits plus currency. Deposits are what are put into the bank. And currency in this framework is going to be physical cash. You can call it public cash on hand, people on what's under people's mattress or what have you. When the currency, and it's important because people have cash on hand, the bank wants you to put it in and loan it out. So then that would be a deposit. and it would be the the actual physical cash or the reserves or what have you. That would be the high powered money, and then what's loaned out would be, you could call it low powered if you want. All of that together, you have the money stock altogether, high powered and low powered. Then you have people spending. So then you have the velocity, which people do care about. And then you have output, people making cars and all this stuff. And then you also have prices. So again, Friedman's critique is that people spend, or the Fed at the time with the Great Contraction and classical economists were spending a lot of time thinking about money as the bottom here, whereas they weren't critiquing properly the higher layers. So, truth number two, banking panics are monetary shocks. Okay, not too controversial. Depositors run from deposits into currency. Again, people think of people taking their deposit out of the bank and having it in physical cash in this framework. Banks defend reserves by shrinking assets and deposits. Now, this is confusing. The bank thinks of, if you were to take a loan out from the bank looks at the loan as an asset to them. So they want to shrink the assets. They're going to do a call on the loans when they want to defend the reserves. They want to defend, you can think of it as the high powered money, the real money, let's say, that they lend out against. With their, again, let's go back to the ratio. When the bank can lend out, to simplify, they can lend out for every reserve. Let's say they have a reserve physical dollar, they can lend out 10, just to think about it. They have a ratio. When they want to defend the reserves, people are coming in and saying, there's a run on the bank or whatever. They want to start defending their reserves. So one they do is shrink assets. They say, oh, we're going to call on our loans, so pay us now, because we want to have high powered money. But the other one is deposits. Shrink deposits. What does that mean? They're not talking about if you went and took physical cash and put it in. They're not talking about that as deposit. What they are talking about is if you took out a $10,000 loan, of course, that's an asset in the bank's balance sheet or what have you. But then you deposit the 10,000 into the bank. They also want to shrink that. So that would be the low powered money. They want to shrink that too. So that would be a deposit, as different from the high powered money. So that's confusing. Failures destroy deposit money. Why? Again, people will, through uncertainty, say, I want to convert my deposit into currency or cash. I want to convert it. And when they sense that there is going to be a lack in convertibility, that's when they go and try to convert it. The panic becomes a contraction in the money stock. Now, there is the idea of a contraction or correction or what have you, and then there's the idea of a collapse. So downturn versus collapse. Milton Friedman's concerned with collapse. To keep there, and so you can think of the big contraction as a collapse, or you can say it turned from a downturn into a collapse, and that's what you want to avoid. And he is arguing that you need to have law to do that, to forestall that.
Yep. And I mean, and to touch on those, there were 4 banking panics that happened between 1930 and 1933. And in all of these, the Fed did not act as a lender of last resort. Instead, gold inflows were sterilized instead of expanding the money, and the money stock fell by 1/3. The book's crucial finding is that this was preventable. The Fed had the tools, open market operations, discount window lending, and reserve ratio changes, which these are all tools that the Federal Reserve would use at their disposal in order to stimulate the economy or to contract it. And what was missing was not the capability, but the clarity of purpose and unified command. So regional banks, the Fed board and the Treasury had divided authority. There was no single entity that had the power and the will to stop this cascade. And the gold standard mentality made things worse. Officials thought that gold inflows should be sterilized to maintain gold parity. And that was exactly the wrong move in a contraction. So the lesson is a stabilizer needs both power and coherence, and the Fed had neither in the right combination at the right time.
Yes, very paradoxical when people quote Milton Friedman. He's always, it seems, and when you go read through this book, which I read this book literally like 20 years ago. And it's a very long, it's 800 pages. So you can very much, it's very dense, and you can get conflicting views out of it, which I got conflicting views out of this book back then, where now I get a reinterpretation of what he's saying. But that whole centralization side was very confusing to me. Like, he is hardcore. You should have government that controls money stock. But he has all these videos saying, I don't like centralization. I want markets to solve everything. So that back and forth of, it's a paradox. And the paradox, if you want to be as charitable as possible, Milton Friedman, the paradox, the way to solve it is to say that there should be a non-discretionary law that says, so it isn't up to the Fed, a non-discretionary law that says increase the money supply by 3% to 5% every year. So almost like something that would be rules without rulers, except for it couldn't really do that.
It sounds quite familiar.
Such thing. Yeah. There's no such thing as a non-discretionary law. You can change the laws. So that's where the paradox comes from. And I also think, in my opinion, he's kind of dancing around some strong pushback that he would probably get from some of these banks. So he kind of just having his cake and eat it too.
Yeah. Was Milton Friedman, was he do you know if he was a Nobel Prize winner?
Yeah.
Okay. Sure. Yeah. Okay. Well, that would be a recurring theme.
Yeah. Anybody, you get the prize, you better act right. you are not going to, be able to be in the in crowd. So, truth number 2, the panic cascade. So this is our diagram. We have the fear. People want to go and get their cash out the bank. So we're going to, in this framework, we're calling, you have the deposit, and you're going to change it into, convert it into currency. The bank shrinks its assets and deposits. We just talked about that, what an asset and deposit is for the bank. The money stock falls. So that's what Milton Friedman cares about a lot. And then income, we talked about money income, but remember, this is related to velocity. It's the total amount of transactions across the economy. And that's people, the money, right, exchanging hands. And then output, cars being made. You're going to have less cars being made. That falls. So everyone agrees that that's a problem. But that cascade, and he's saying what's higher on this diagram, what's higher in the cascade, that's what he's saying is the causal. Now, the contraction was preventable. This is controversial. Why? By early 1933, and we reviewed some of this already, the money stock had fallen about 1/3. So we're already in trouble. The banking holiday came after a massive banking failures, and a prompt reserve support could have changed the path. So he's saying they had the power, and they misdiagnosed on one side. They also were divided, and so they were a bureaucracy, so they were incompetent or couldn't move because they weren't centralized enough. Paradox. So banking failure turned a downturn into a catastrophe. He's saying that it was simply the Great Depression of the 30s could have been prevented because it was misdiagnosed, but through managing the monetary stock, the money stock, it could have been prevented. It was a money stock problem, he's saying.
Yeah. I mean, so here, I mean, we can look at the policy failure, right? So in terms of Milton Friedman here. So the Fed was built to stabilize, but lacked a unified command structure. Regional banks, the board, and the Treasury had different incentives and different interpretations of their mandate. Um, so, I mean, this is not just historical curiosity, but it's a governance pattern. Divided authority in a crisis produces incoherent response. No single actor has both the information and the power to act, and everyone can say, that's not my responsibility, or I'm waiting for guidance. And in those situations, systems freeze. So, I mean, we're going to, speak on Bitcoin is even when you build a stabilizer, because we were talking earlier about having rules without rulers. Even when you build a stabilizer, you have created a choke point. But if you don't build one, you're vulnerable to the panic cascade. And there's no escape from the trade-off, only the question of who holds the lever and what rules constrain them.
All right. So preventable contraction, downturn begins, like we were saying. You have large bank failures, no sufficient offset, so the Fed didn't step in when they should have. Then the money stock is down 1/3, and then you have the catastrophe. Instead of just merely a downturn, you have a collapse. Now, centralization is not competence. The Fed existed, but leadership and doctrine failed. The power moved towards the board over time. So there was somebody who was kind of you can say a cult of personality. They were a charismatic leader. They left. And so now it was a board. And then you had the divided authority. More control can mean more concentrated error. So just because you have centralization, obviously, I think trivially true, doesn't mean you're going to make the right decision. It does mean you can make fast decisions, but you can make a fast wrong decision. So a central lever is useful only if it's governed well. Fine. So here's the policy error loop. You have bad doctrine. Again, this is a critique of classical economics and even neoclassical economics, saying that money is more important than what you're saying, what the classical economists and political theorists and stuff believed. The signals were misread, so they weren't paying attention to destruction of deposits. You have a delayed or tight response, the contraction worsens, and then the panic confirms the wrong fears, which his argument is that it wasn't a market failure, it was uh, a failed response of the Fed to handle the money stock problem. Policy meaning stable money, not omniscience. So you want to prevent collapses in the money stock. You want to stop banking panics before deposits disappear. Don't confuse administrative control with monetary stability. And rules matter because discretion can misread the system. One of the arguments that he makes in the book is that if there was the Fed had the capability of doing FDIC or some type of banking insurance, if there would have been banking insurance at the time where where you incentivize people, or you weaken the incentive for people to withdraw their money to convert to currency, that could have prevented the collapse, he's saying. And they had the ability and they didn't do it.
Mhm.
All right. So here's an argument that the central bank makes a choke point. Bank deposits are money. And then just to make this a little bit more clear, you have high powered money, things that can be, that have the potential to be uh, rehypothecated or loaned out, to be multiplied. So when the bank, counterintuitively, when the bank makes a loan, they're creating money. The deposits are the limitation that they have. They can only loan out so much, but when they do that, they create new money. Panics can destroy deposit money. That's the reserves. A stabilizer, and that is dangerous. The stabilizer needs authority over liquidity and guarantees. So this stabilizer is what it is. That's the authority that's going to be able to make it to where you're doing what Milton Friedman says, which is control the money stock or be careful with it. That authority is also a discretionary choke point. Discretionary, meaning in this argumentation here, meaning they can not obey a rule that was made by law or what have you. They can do it in a whimsical way, arbitrary way, apply it when they feel like it. That would be more discretionary. He doesn't like that. But the argument here is that the authority is going to be a discretionary choke point. So if you have stabilization and you're going to have capture risk, they're the same lever. So stabilizing and capture risk are together. Now that's if you hold stabilizer needs authority over liquidity and guarantees, or the authority is also a discretionary choke point. The rules without rulers is saying it's not discretionary. So that's where the way out of saying that you have an authority with discretion. But if you were to say, if you were going to have a critique of central bank, you would probably go down some line of reasoning here. Yeah. So now, for our critique of the book, for the audience that we're speaking to, this portion here, we're talking about software craftsmanship. If you were to take the nomenclature, the language of this book, and you're trying to make frameworks out of it, how would you go about doing that? So, creating a language for monetary diagnosis. There's going to be three go-to books, and we could even say communities that I'll go to as far as talking about how you would do software craftsmanship and architecture for any type of difficult domain. Monetary monetary policy would be one. So treat monetary history like a language. And one of the books that I refer to over and over is called The Structural Interpretation of Computer Programs. Within that, there's a critique of language, how you would critique a programming language or language in general. So there's going to be primitives, there's going to be composition or methods of composition, and there's going to be abstraction. We're going to apply that to this domain of monetary diagnosis of Milton Friedman. So what are the primitives? We've said a bunch of them: base money, high powered money, deposits, reserves, currency, velocity, confidence, and authority. Those are base concepts. Now you can compose them. Methods of composition. One example: ratios plus bank runs plus policies. That explains how money expands or disappears. So you have your composition there, and you kind of have a meta composition, or kind of the workhorse within a language, which would be the fundamental method of abstraction. These could be reusable patterns. So the money stock chain, that diagram we brought up before, for explaining that operating system of money, panic cascades, preventable contraction, and choke points, you can use these as a way as workhorses to describe or solve problems within the language. So that would be your method of abstraction. And then one of the things that you want to do with this software craftsmanship, you wanted to create a language and solve the problem in the language. You create a language. This is a ubiquitous language. So people can all speak the same thing. You're not getting down into what a compiler is and software or what have you, but you are using the same language that a domain expert would use. So in this case, an example would be naming the money flow patterns. So builders, so you have the people who are creating something like a parallel economy or something like that, software for that. You'd make it so that the builders can diagnose their own systems, but you'd be leveraging the tools that a domain expert, in this case, monetary policy, would have.
All right. So this is the exit pattern slide. And this is going off of the idea if the central bank is a choke point, how would you exit? Right. So here we have four paths ordered by viability. First, we lead with Bitcoin. We have parallel banking. We have multi currency competition, and then full reserve banking. All right. So Bitcoin is the high viability exit, right? It has a fixed supply, no issuer, and there's no lender of last resort. And it functions on rules without rulers. All right. The second would be a medium viability exit, and that would be parallel banking. What this means is this is referring to credit unions, community banks, cooperative banks, and building societies. Examples of this would be Navy Federal Credit Union in the US, Refusal banks in Germany, or the Nationwide Building Society in the UK. They're parallel because they have a different governance. They are member owned versus being shareholder owned. And they have different incentives with often more conservative lending than larger banks typically would because they have more capital. And why does this have a medium viability? It still operates within the central bank's monetary system. It's still subject to regulatory capture. It does have scale limits, which prevent global reach. But the governance structure is more resistant to certain forms of capture. And this I bring up parallel banking because I mean it really segues into the idea for the crypto curious individual, right? Credit unions are the historical analog to DAOs, which are decentralized autonomous organizations. They are member owned, they have different governance, and they are parallel to the dominant system. But credit unions still use central bank money. Decentralized autonomous organizations can go further and use non state money. But the catch here is that non state money often still has an issuer and still violates price, which is our framework for no pre mine, no roadmap, no issuer, and no censorship. A DAO token can be diluted, a stable coin can freeze your account, and a protocol can change its rules. Parallel governance with issuer money is not the same exit as parallel governance with no issuer money. So the emerging option when we, relate it back to Bitcoin would be fediments, which are Bitcoin native federated mints that use blind signatures for privacy. And this is especially useful for people who may, if you're building for people in oppressive regimes with unstable property rights and need certainty to hide their financial information and activity. Users deposit Bitcoin and receive eCash tokens. The bearer instruments are spendable privately with inside of the mint. And to redeem eCash for Bitcoin, you would need enough guardians to sign off. Now, the downside here is that if enough guardians collude, say 4 of 7, you're stuck with eCash that you can't redeem. But the exit in that regard can be a choke point, but it does require guardian coordination. It's not just a single party action. And the trusted federation members, I mean, just to kind of seal the fact that it doesn't always have to be an issue. The trusted federation members don't have to be strangers. They can be your friends, they can be your family, or any technologically sound community members that you trust the most. But it's better than parallel banking on money, but not as clean as pure Bitcoin governance. That was quite a bit just for the parallel banking aspect, but we're going to go into the last two and we're going to go through those quickly. The medium viability exit number two would be multi-currency competition. And what this means is allowing multiple currencies to compete as legal tender or de facto money. Examples would be countries with dollarization where they do accept US dollars, but they do also have their own national currency. It would be, or crypto adjacent economies like El Salvador, where Bitcoin is used frequently, and then historical free banking eras. So why is it medium viability? Well, there is a ton of legal risk. Governments often ban competing currencies because they want their national currency to be the legal tender. So there is complexity for users because you have to have an understanding of exchange rates and also convertibility when making purchases, and it introduces competition that constrains the central bank. So if you're using another currency within the economy that you're in, it could be stronger than your nation's currency, and you just don't want that type of competition at all. And the last is the low viability exit, which is full reserve banking. And what this means is the bank must hold 100% of reserves against deposits, and there's no fractional lending. So this is low viability because it requires a ton of regulatory change. You would have to do a lot of political lobbying, and it would face interest from the current banking system. So, and it's also historically rare. The Chicago Plan in the 1930s. This was the first idea of it, but it was never really implemented, at least not on a. So the key question for all of these exit patterns is, what are you willing to pay and what skills do you need? Well, with Bitcoin, the cost would be, of course, it is volatile as it is, but it has volatility has been decreasing as the asset has been maturing, and there is an adoption curve as as more um, as more people are getting on are adopting Bitcoin, then it begins to stabilize. And the skills would be self custody, learning how to take your own possession of your Bitcoin, and also how to manage your keys. For parallel banking, the cost would be scale limits, right? We were talking about credit unions. We were talking about, Raiffeisen banks in Germany. Like these are not, these are very regional banks. They do not grow at scale, right? And there's a lot of regulatory risk. And it would require, as a skill, community coordination. For multi currencies, the cost would be legal risk and complexity. Skills would be financial literacy. Again, you'd have to know the exchange rates of multiple currencies. And then full reserve banking, the cost would be regulatory capture and lobbying. The skills would need to be political coalition building in order to make the dream work here. So, with that being said, that wraps up this slide here.
All right. Excellent. Now, the last aspect of this critique, we're going to talk about builder usability and how to make the money flows legible. Again, this is creating something and you're trying to get adoption. So, when you create, if you're trying to maximize adoption for something, you're trying to build a parallel economy framework or components, you want to make the happy path Expose what? Expose within this domain liabilities, liquidity, settlement, and exits. You're exposing all of that from the beginning. Now, what else would you want to do? Convention over configuration. Again, you're trying to make it to where people can adopt what you build quickly. So, for instance, standard money flows, you'd be able to see those by default. Remember the money flows and the diagrams that we're talking about and the ways to reason about this domain. Omakase. What is omakase? It's chef's choice. So you go into a restaurant and you say you have a large menu, small menu, or what have you. You could do a la carte. Omakase is I trust the chef. I'm here for a reason. They know what they're doing. One thing that you get from that is ease of use. It's very easy when you go in and say, I just want there's 2 things on the menu, 3 things. I'll take this set when I order. Very opinionated on how things should be, let's say, cooked. In this case, you're making a framework. You start out with strong opinions, and then you make it possible for people to change. So in this domain, you could say you can have an opinionated dashboard for claims, reserves, settlements, and runs. Again, in this fictional idea or conceptual idea of making some type of parallel economy framework or what have you. Integrated systems first. So ledger, audit trail, alerts, all of this stuff, you're making it for one community first, and then you're expanding out. And then the idea of lean, when you're shipping, you want to ship the smallest useful thing. So it would be diagnostic in this framework as an example. A useful diagnostic before the crisis. If you were trying to make it to where you're having this monetary system, maybe you have a monetary system inside of a large multi-role-playing video game, and you want to have it to where there's economies within these things. You should have some type of diagnostic for finding out that there's going to be a crisis. So questions to contemplate. Where do you treat deposits, credits, or balances as if they were risk-free money in your own life? What would a run look like in your system if you're building a system? Who can stabilize the run, or what power does that give them? And what rule would prevent panic without creating an arbitrary choke point? Really difficult to figure that out. Now, conclusion, money is an institutional infrastructure, not neutral wallpaper or a veil or what have you, classic economics view. Deposits make banks part of the money stock. Panics can destroy money unless something stops the cascade. And the stabilizer is also the choke point. So if you one thing away, it's this: deposits are money, so banking panics are monetary contractions. Friedman and Schwartz force us to diagnose the plumbing: where money is created, where it disappears, and who has authority to stop the collapse. For Bitcoin people, the hard question is not whether stabilization matters, it's whether the stabilizer can be governed without becoming the capture point. Some practical builder questions are, what would a run look like in your system? Where are the redeemable promises? What are the maturity mismatches? And where are the hidden leverage points? Who can freeze, guarantee, inflate, censor, halt withdrawals, or change settlement rules? So if you have any comments, leave them in the comment section and visit bitlemmas.com for past episodes and other information, and we'll see you next time.